Imagine an investment that promises calm, not excitement, where the beauty lies in steady numbers and predictable payouts. Citicore Energy REIT, the Philippines' first energy-focused REIT, embodies this discipline. In 2025, CREIT's rental income stood at 1.88 billion pesos, nearly unchanged from the previous year. Net income was a steady 1.43 billion pesos, while cash flow from operations comfortably covered its dividend payments, reinforcing what income-focused investors value most: reliability. Dividends tell the story. Annual payouts were 0.202 pesos per share in 2025, barely up from 0.201 pesos the year prior, and with quarterly distributions exceeding the minimum required by REIT law. For those seeking yield, this orderly progression isn't boring, it's beautiful. What's behind the durability? CREIT's lease agreements are tied to renewable energy properties, anchored by guaranteed base rents and modest upside through variable rent. In 2025, contractual rents made up 1.67 billion pesos, with variable rents contributing 50 million pesos. This means the dividend isn't based on volatile assumptions, but on long-term contracts. Operational strength is clear. CREIT maintained a gross profit margin near 94% and net profit margin close to 76%. Its properties are fully leased, with contracts stretching into the late 2030s and 2040s. The balance sheet is resilient, featuring 9.99 billion pesos in assets, solid equity, and prudent debt supported by an AA+ rating. CREIT still has substantial borrowing headroom, reflecting flexibility, not fragility. Yet, stability must not be mistaken for invulnerability. Dividend coverage is solid, but not excessive. A landlord paying out most of its earnings can manage minor setbacks, but consecutive disappointments would prove challenging. 3 risks warrant attention. New asset acquisitions may require equity issuance, meaning portfolio growth doesn't always translate to dividend growth per share. Tenant concentration is high. 90% of capacity comes from the top 5 lessee customers, with 55% from the largest. A disruption in the sponsor's chain could echo through the REIT's income. And finally, refinancing looms. CREIT's bond matures in 2028. Elevated interest rates or new funding needs could impact distributable income. The fundamental story remains sound: a coherent, high-margin landlord with visible leases and disciplined payouts. Yield investing demands vigilance. Watch for cracks in asset infusions, tenant concentration, and refinancing. For now, the machine hums steadily. Wise investors, stay alert for any change in tone.